Oil prices have surged recently, and the immediate assumption most people make is that inflation must be heading higher as well. It feels intuitive. If energy costs rise, everything else should follow, and inflation should accelerate alongside it. But the reality is more complicated, and this is where markets often behave very differently from what people expect. The key issue is timing. Oil moves in real time, reacting instantly to geopolitical events, supply disruptions, and shifts in sentiment. Inflation, on the other hand, is a lagging measure. It reflects what has already happened, not what is happening right now. That creates a gap between perception and reality. By the time inflation data starts to reflect higher oil prices, markets have usually already reacted. Bonds have repriced, equities have adjusted, and positioning has shifted well ahead of the actual data release. So when inflation numbers finally come out, they often don't move markets as much as people expect, not because they don't matter, but because they are no longer new information. But there's a second layer that most people overlook, and this is where the real insight lies. Higher oil prices don't just increase costs, they also reduce demand. When consumers and businesses are forced to spend more on energy, they inevitably spend less elsewhere, and that begins to slow the broader economy over time. This creates a dual effect. In the short term, higher oil prices can push inflation higher, but over a longer horizon, they can actually become disinflationary by weakening demand and slowing growth. Markets are constantly trying to balance these two forces, immediate inflation pressure versus longer-term economic slowdown. And that's why price action can often look counterintuitive. You might see oil rising sharply, yet inflation expectations remain stable, or even fall because markets are already looking ahead to what happens after the initial shock. And that's the key difference between how most people think and how markets actually operate. Most people see rising oil prices and assume inflation is going higher. Markets see rising oil prices and ask what happens next, whether it leads to sustained inflation, or whether it eventually slows the system down. That gap between expectation and interpretation is where mispricing happens, and it's where the real opportunities in markets are created. So the next time oil spikes, don't immediately assume that inflation is about to surge. Instead, think about timing, think about demand, and think about what the market has already priced in. Because once you start looking at it that way, you're no longer just reacting to headlines, you're starting to understand how markets actually price the future. Most people follow the news. Capital theory focuses on how money actually moves. If you want to see where money is flowing before it becomes obvious, follow.